Rising trade tensions sinking stocks on Wall Street Tuesday. The S&P 500 down 0.7% right now. It's still well below its 50-day moving average. Well, let's see what the charts say about what lies ahead. We're joined by Randy Watts. He's Chief Investment Strategist at William O'Neill & Company. Welcome back, Randy. So we saw the S&P 500 try to break out late last week, but then give back some of those gains Monday and again today. So what do the charts say about where we are now, where we're headed?
So the charts say it's been a very choppy market. The market's basically been trading back and forth between the old highs and the 200-day, and it hasn't been able to really bust out definitively on the upside like you said. The technical picture has deteriorated for the market. If you go back about 3 weeks ago, you had about 75% of the S&P 500 above their 50-day moving average. Right now, that number's under 50%. It's about 48. In addition, out of the 11 major sectors, only one of them is meaningfully above its 50-day moving average. That's the utility index, which is obviously a defensive group. So technically, the market has had a tough time here. We would hope support would hold at the 200, but we would not be surprised to see it go through the 200 back towards maybe those June lows.
So possibly break through the 200-day moving average. What makes you sort of bearish or pessimistic?
I think there's a couple of things. First is that the trade wars continue to go on. There hasn't been any resolution, and it now looks this week with the news out of China that it's going to be harder to get an all-encompassing trade deal between the U.S. and China. The next thing is that we think earnings estimates for next year are way too high for stocks right now. The market's looking for the median S&P company to have about 3% earnings growth this quarter. That's about to be reported. But the market's actually forecasting 10% growth for next year. We think that's too high. That's probably got to come down to sort of the mid to high single digits. And then finally, the economic news, both globally and the U.S., continues to slow, as we saw last week with the ISM numbers.
So you've got a pretty bearish outlook. How low do you see it going if it cracks below the 200-day moving average?
We think that, the June lows, then possibly the March lows, so maybe in the 2,700 type area is where the market could bottom out. But I think what's really going to happen is that the market's got to get through this earnings season, deal with what we think is going to be a downgrade in earnings, and kind of readjust to those new levels.
Well, Randy, we got the wholesale prices, the PPI come out today, Producer Price Index, and it unexpectedly fell. That makes the market think, well, are we going to get a Fed cut? Isn't that going to happen? And won't that help stocks, or you see still stocks under pressure?
We think the Fed's easing cycle will help stocks and the economy over time, but it usually takes 9 to 12 months for those cuts to work all their way through the economy. Right now, if you look at the Fed funds futures rates, they're looking for about a 60% chance of a cut in October, but over a 90% chance for a cut in December. So we do think more rates are coming, but it's going to take a while for that to feed through and help the economy and the market.
Any sectors that look attractive at this point?
We really like the growth sectors still because we think the U.S. economy is going to be growing slowly next year. So we still like cloud software. We like select internet and media names. We like select areas of consumer discretionary retail. We like medical devices, and we still like long-term the financial payments industry, which is companies like Visa, MasterCard, and PayPal. But a lot of these leadership growth stocks right now actually don't look good on a short-term basis. They've been pulling back, and we're looking for these leaders to start to base out and consolidate before telling clients to get more aggressive on those growth names.
Okay, but hold off for now then?
Hold off for now.
All right, thanks a lot. I'll take that advice. Our thanks to Randy Watts of William O'Neill & Company. I'm Fred Katayama, and this is Reuters.